This is Trader's Workshop with Adam H. Grimes. Hello, and welcome to episode 18 of Trader's Workshop, Trading Markets Under Stress, Part 2. I'm your host, Adam Grimes. You can find more of my work at adamhgrimes.com, and you should follow me on Twitter at adamhgrimes. So before we get started, a few kind of administrative things. If you're listening to this in real time, I have to tell you that I'm very excited about some of the things I have for you in the near future. Many of you are familiar with the trading course, and if you aren't, let me take just a moment to tell you about that. There is a gigantic and extensive trading course that I first created in about 2012, 2013 when I published my first book. And since then, it's undergone one complete revision. There's a workbook, and this is not a plot to sell books. Most of the workbook is available for free in a section PDFs that go with each course module. And there's hundreds of PDF exercises, hundreds of pages of exercises, about 30 hours of video, and it really is designed to be a comprehensive course in technical trading. Thousands of traders have been through it, and I have many, many emails from traders who, from all walks of life, all experience levels. Many people say that this has been the piece that has finally carried them to profitability after many years of paying for many courses. And the other thing is the course is free, but don't make the mistake of assuming it's worth what you pay for it. So go check out the course. It's at marketlifetrading.com. And I am in the process of creating an options course. This is something that I think there are some holes in the way that options are traditionally taught. And I want to work toward both a more precise understanding of option pricing. And when I say option pricing, I don't mean working a theoretical model in a classroom situation. I mean understanding, okay, so I have this call, and what can I expect as the underlying moves? If you understand that, so what we're really working toward is an intuitive understanding of how price moves and also of some of the important Greeks. If you understand that, it's much easier to understand options positions, not as these structures that you get from books and you say, oh, I'm going to put a broken wing butterfly on this trade. You're not really trading the structure. What are you trying to accomplish in the market? And so I think if we can build an understanding from the individual pieces, that I will be able to help people have an understanding of options. And I don't think there's, at least the educational material that I've seen, there's some very high quality educational material, but frankly, I think I can give you something that's not out there. So I've started work on that. I'm very, very excited about that. Many of you know I've been away for a couple weeks, had a lovely vacation in Italy and got a nasty cold on the way home. And I've held this podcast off for a few days so I recover from that. But starting this next week, you're going to see me much more active on my blog. I have some exciting topics there. And we have added a new person to our Market Life and Talent Advisors family who's going to help me answer and stay on top of emails and contacts. So in addition to doing other things. So I'm excited. And I'm also very excited to continue the podcast series here. And we're going to, Tom and I have some really kind of cool things planned, including a very structured set of sessions with a new and developing trader. So you'll kind of get to see how it works for somebody and maybe get some of your questions answered along the way. So with all of that behind us, let's jump into this topic. If you have not heard episode 17 that comes before this, maybe go listen to that, either now or after. I'll give a very, very short summary of that. So the question we're really looking at here is, how do we manage markets when volatility hits the market? When a market goes crazy. This is October of 2018, and stock markets have just gone crazy. And they also went crazy February of this year. By the way, I've been out of the United States twice, and this year, and it's twice this year, and both times the stock market semi-crashed. So I don't know what's up with that. That's actually a blog article I'm going to write on that topic, and how if you do statistical analysis, you also have to use some common sense, because the p-value of me going out of the country and the market crashing is quite high, and we know of course that's nonsense. But so we've just had a very volatile market, and in the previous episode I talked about volatility at some length, and what volatility means, how it manifests, how we measure it. And then I also talked a little bit about specific price structures. And I've written about those in many places, certainly in the trading course at marketlifetrading.com. We talk a lot about those and about trend terminations and trend integrity. So that might be a good way to see some of the things that we're talking about here. But today I want to talk about two more topics related to markets under stress. And the first topic for today is a very appealing topic. How do you tell if a trend is broken? So, in other words, how do you tell if this shock that just hit the market is going to break the back of the bull market, just to say very clearly, or is it just noise that's going to resolve? And then the second topic for today is practical trading tips. What can you do? What have I done? What have I struggled with? What have I seen other traders struggle with and figure out to help deal with all of the challenges of trading markets like this? So first of all, how do you tell if a trend is broken, or is it just noise? Well, I'll say up front, there's no 100% way to do this. If there were a way to do this with absolute certainty, it would be the holy grail of trading. And we know that can't exist, right? So imagine that you had some tool anytime a trend is going up, that you had a tool that would tell you definitively when that uptrend has ended. All you would do is get short, right? And you would execute that trade over and over, and very soon you would buy some small country somewhere because you would have all the money. You would basically end up with all the money in the world. And of course, it does not work like that. So as a gentle reminder, any tool we have, and even the best tools we have, only, I guess it's kind of redundant, right? Will only work within the bounds of probability. But there are some things that we can see that occur with some degree of regularity that can help us tease out the important things from the noise. And I've written about this before. One of those tools I would just call, hey, that's different. And that came up when I was working at a prop firm and mentoring, training a lot of traders. We were trading very short time frames. And what you will do, if you look at a price chart, you don't need to read every bar. In fact, I think you probably shouldn't, because there's so much noise, so much meaningless random action in your average price chart, that what you really want to do is pay attention when something changes. And so then we come up with this class of things that we would call, hey, that's different. And some examples would be very big bars. It can be that simple. If you look at a price chart, you'll be able to define how big the bars are. Now, of course, you can measure this, average true range or just average range, where you're simply averaging the high minus low of each bar. You do that over some time window. It doesn't even really matter what time window you use. Everybody wants what's the right setting for the indicator. Well, think about it, okay? If you're averaging the past 5 days, so you're averaging the past week, compared to averaging the past 2 months, and they're roughly 20, a little bit more, but it's roughly 20 trading days in a month. So let's just say 40 days. The difference is going to be that if you graph it over time, you will see the shorter measure is a lot more volatile. It changes a lot more. It's just math, right? If you have 5 numbers and you drop one and add another one, you're probably going to change the average more than if you have 40 numbers and you add another one, you drop one and add another one to that average. You just have more numbers, so it takes a lot more to move the average around. From a practical perspective, A lot of people use 14 period average true range. People will use 9 period average true range. That's fine. I sometimes will use a quarter because this won't work out perfectly, but I would like to, if I'm looking at stocks, I kind of want to capture the earnings event, which, and you might reasonably say, well, wait, if that was 2.5 months ago, how relevant is that to today's action? Good question. Answer is, I'm not sure. Yes, sometimes it might be very relevant, sometimes maybe not much, but I still want to know what the average amount of movement we have on the price chart is, so that when we have a big move, I can see that. It was very, very easy in most software packages to create an indicator that says today is X times the average true range. And you'll see a lot of days that are 0.7, 0.8, 1.2, 1.5. Okay, no big deal. But when you see some 3s or 4s or 5s, it's time to pay attention. My preferred measure actually is looking at a close-to-close measure and looking at a standard deviation of that, something I call sigma spikes. And it's basically, I think the average range measure is a little bit more intuitive, but if you Google Adam Grimes sigma spikes, you'll find some blog posts that I wrote on it. It's not at all complicated. It's not a secret either. Basically, it's so many times in my career I've reinvented the wheel. I don't think it's a bad thing, because I think when you reinvent the wheel, first of all, you're doing the right kind of work, right? You're thinking about things in the right way. And I probably understand the wheel better than a lot of people because I've invented it several times myself. But I invented this measure, sigma spikes, and then discovered that basically every risk management system in the world uses some very close variation of this or the exact thing. So it's not unique to my work in any way, but I've written about it in a way I hope you can understand. Anyway, what we're looking for are big days. And if we have a market that is uptrending, I think this is logical, right? If we have a market that is uptrending, we probably should not see a lot of sharp downward spikes, right? You're going to see some, but what makes a market go up? People buying, people being willing to buy. And one of the things that we like to see in terms of trend integrity is no market goes straight up. That's not healthy either. Markets fluctuate, but we want to see that there's some regularity, some predictability in the fluctuations. And this is why I think a lot of people get kind of sucked into all of these wave methodologies and ratio methodologies. I don't think there's really anything to most of those, but markets do kind of move with some consistent volatility and with some regularity in swings and swing length. And this may lead us to think things are more predictable than they are. Really, it's just movement with a consistent volatility. And one of the things that we do like to see is every time the market declines, people are right there to buy it. And you can see this if you look, for instance, with stocks. If you look on weekly charts, a lot of times you'll see weekly candles that have these long lower shadows. So maybe the market went down in the course of the week, but then it went back, it closed higher at the end of the week, or did not close at the lows. So it probed lower and reversed higher. You can see this on daily charts too. But what you don't really want to see is the market sells off and nobody buys it. Uh-oh, right? That's a little bit scary. And particularly if it's a market that has not exhibited that in the course of the uptrend. That's a sign that something is different. And when we start seeing these moves that are very large, and what we saw here in October 2018 on a volatility adjusted basis was one of the 4 or 5 biggest volatility adjusted declines that we had ever seen in the history of the S&P 500. For parallels, we have to go back to October of 1987, and most of you know what happened then. And then the volatility from that 1987 crash kind of reverberated for a few years, and we had another huge decline in 1989, and then January of 2007. And I don't know. Actually, I don't know that it was January, but it was early 2007. I believe it was January. I'm not sitting in front of the screen to look, but this is I don't remember the date, but I remember the event very clearly because it was the kind of shock that allowed me to go into 2007 and then into 2008 anticipating a downturn in stocks. The hit that markets took in early 2007 was so unsettling and so out of character with the trend. And the aftermath, that's something we're going to come back to here in a moment. The way the market reacted after that decline put me in an extremely defensive position. And that's where I am again today. And those of you who have read my macro work, my long-term work for years, you know I've been consistently bullish on stocks. And I'm not bearish on stocks, but I'm now extremely cautious. I'm cautious in a way that I have not been for many, many, many years because of the character of this decline we've seen in October of 2018. And so this is a real world example. Now, what do I mean by aftermath? Okay, so you have a peak. You have a market that's trending up. Just visualize this. This is relatively simple. You have a peak, market goes up, and then it gets hit in this big decline. The big decline may be a single day. It's probably not. What almost always happens is you have the peak, then you have a few days, maybe even a few weeks of sideways down like normal pullback, and then you'll have the hard hit, and then you'll have a couple days after that where the market might probe lower. So when we're looking at the downswing, what we're looking at is the distance, even though there may be several events in there. And we don't care about news. We don't care about what information. Undoubtedly, information generated those moves, but we don't care. We just care about the price response. And so what we're looking at is the difference between that peak and the ultimate low. That's the length of the downswing. Now, if you take that and you look at the 50% level, this is not an exact ratio because what we're going to look at is a very, very wide band around that 50%. In fact, if you want to draw nice lines on your chart, and I don't, it's enough for me to see it intuitively, but if you want to draw nice bands, I think I would put a line at 50%, and then I would put a line at 25% and a line at 75%. So really, you're blocking out kind of half the zone of that retracement, or I'm sorry, half the zone of that decline is the zone that you're looking at, but it's sitting in the middle. You understand? So it's 50%, but it's centered around 50%. And then what I want to see is how the market reacts around that 50% level. I shift my thinking to imagining, okay, whether or not I'm going to do this. So, don't tell me I don't short stocks. Don't tell me I'm a long-only portfolio manager. I can't short stocks. You're missing the point if you're thinking that. I'm not asking you to short. I'm asking you to think like somebody who's going to short, okay? Because that will allow us to understand the price action. So we put on our short hats and we say, if I were looking to set up shorts, how do I feel about the price action? Now, you have this market trending up, right? And then boom, it gets hit. And then you look at what happens when it bounces. Two things can happen. A lot more than two things can happen, but let's move it into two categories. One is a very quick recovery. And this happens a lot. The market, in fact, this is what has happened. It even happened in February of 2018. At least that's the way that I read the price action. So in February 2018, I was expecting stocks to make new highs later in 2018. And frankly, I was expecting us to take out those highs and scream higher. Again, most technicians got very bearish in February 2018. I think it was a mistake. Here's why. Because the character of that bounce after February 2018 was a very sharp recovery. Now we oscillated and there was some garbage. There were some retests of lows. Not every index went up. Yeah, okay, but it's a quite different thing than if you were looking to short in February of 2018, you had a really hard time. And, I was, right? I was looking for these setups. And the way the market snapped back, you just had to look at it and say, oh, I can't short that. Contrast that to a market that goes down and bounces, I use the word reluctantly. So it doesn't even get back to that 50% level, or if it does, it gets back to in kind of an up and sideways. Maybe it sort of grinds up to it. And yeah, we can see some shapes on charts. And I know some of you listening to this are highly suspicious of charts. We'll talk about that in another podcast episode. But I will tell you that there are heuristics that we can take out of patterns on charts, and they are incredibly useful. And there is incredibly useful information encoded in charts when you read them correctly. So if the market bounces reluctantly, that really is the difference. And I know this doesn't seem terribly sophisticated. You were probably hoping for indicator readings. You were probably hoping for maybe some math. But it really is this simple. This has served me well. I'm talking specifically about stocks, but in uptrends and downtrends, in every asset class, and in every time frame. I think it's a little bit harder in short time frames because the emotional management is a little bit different. But for swing trading, this is a fantastic tool for understanding trend integrity and understanding what kind of move is likely to break a trend and what kind of move is likely to see a trend continue. Now, there's a lot more. I could talk for days about this. For instance, let's say a market is uptrending, and then you have a sharp spike in the direction of the trend. What do we think about that? Well, that's kind of a complicated thing because that could sometimes lead us toward exhaustion and overextension, or it could lead us to an acceleration of the trend. So there's subtlety, but overall, I think, and many people have asked me this question over the past couple of weeks, how do you know if the market's going to continue higher or if the trend has ended? And what I've told you is the best tool that I know. Yes, it's a discretionary tool. Yes, it's subjective, but it is also based in the reality of behavioral economics, if you will, and investor behavior as it's revealed in the motion of the market. It's a powerful tool. It's real. It works. Okay, so now, practical trading guidelines. Well, first of all, I think what you need to do, whether you are a trader or investor, you need to be clear, crystal clear who you are, why you trade or invest, how you trade and invest. When markets get volatile, this is a really crappy time for you to switch horses. In other words, if you're a long-term investor and you just took a bunch of losses on your tech stocks and your consumer discretionary stocks, do not go into the market and say, okay, I'm going to be a day trader. That is one of the stupidest things people can do. I've done it. I can say you're stupid to do it because I've done it myself many times. And not many times. You learn pretty quickly or you don't continue in the business. But what you need to do is maintain the discipline of following your methodology and staying true to who you are as a trader or investor. Now, if you're trying to figure it out, as I know many of you are, there's some advantages and disadvantages to this kind of environment. It can be a little bit tougher. The swings are going to be bigger, so it's very easy to blow up your entire account in a very short period of time. And the swings are bigger. The market naturally becomes more emotional, so traders become more emotional. And this is something I think is very important for you to know. Many of us are very surprised at the emotional reactions that we will have to the market. Because you study, you learn the math, you learn your setup, you create your trading system, but then when you go to the market, why? Why is it so emotional? Why do we so easily become angry, confused, scared. And why do these emotions, why do we become really enthusiastic and load up into a position just when it turns against us? Why do we hold on, and finally vomit the position out in desperation right when it turns back in our favor? And why do we do this over and over? Have you done that? If you haven't, you probably haven't actually traded yet. Because anybody who trades for any length of time, you'll do this. And if you don't know what's going on, it's very easy to start to think things like, I'm stupid, I can't trade, I'm not meant to do this. That's wrong. What you need to know is that these movements we see in the market are created by the emotional reactions of market participants. So the movements of the market actually encode the emotions of market participants. So your emotional reactions are completely normal. Not only are they completely normal, they're almost unavoidable. So the issue really becomes this idea that you're going to be an unemotional trader. I don't think that's true. You're human. You're not a Vulcan, from Star Trek, where they supposedly did not have emotions and were purely logical. You're not a Vulcan. You're not a computer. You're a human being. And every decision you make as a human being is made through a combination of rational analysis and emotion. That's just the way we work. And particularly in the market, which we would like to think is so very rational, we become so incredibly emotional sometimes. So you're not going to eliminate emotion, but what you need to do is develop awareness of your emotional state. You need to accept your emotional state. Don't push it away and say, I should not be feeling this. I should be strong. Particularly, this is a very masculine approach. And I say that because women are usually smarter than this. The masculine head-on approach is to say, I should be strong enough to not experience these emotions. It's not true. You can't overpower the emotion. What you need to do is accept it and invite it into your experience and then basically work around it. So you're not letting the emotion tell you what to do. You're not letting the emotion shape your behavior. You're having the emotions, but you're not making actions that are dictated by the emotion. And the only way you get there is through acceptance and awareness of your emotional state. So be aware that when these markets go crazy volatile, you're likely to have even stronger emotional reactions. And the two that you need to guard against most brilliantly, I think, are fear of missing out. Because you'll see these big moves. Cryptocurrencies recently, very good example. You'll see these big moves and you'll think, oh, I should have been on board. Let me jump on now. Well, guess what? Or you think, oh, if I don't get in the market now, all the opportunity is going to go away. I gotta be in it. I gotta be in it to win it. You start to think stuff like that, and then your emotions are driving. So guard against that fear of missing out. And the other one is just fear. You'll look, you imagine, what if my stop gets slipped? What if it gaps open under my stop? What if, right? You go on and you can easily be paralyzed by fear. Or you have a position on, let's say you have a position on, and then the market moves much more than you expected, much more quickly than you expected, and you have a much larger loss than you expected, and you didn't have a stop in the market, and you can't bring yourself to push the button. I've seen traders actually physically be unable to push the button. It's a weird quirk of psychology, but sometimes the finger just does not work. You are literally frozen, paralyzed by fear and surprise. And these are the things that as we're in the market a little bit longer, we get over most of these. And some of us deal with these easier than others. And we all have our weak spots. You have to figure out what your weak spots are and then make them not weak spots. But it begins again with being aware of your emotional state and accepting that it's legitimate, and then working with it and working around it. One other clue that I could give you is, so there are several schools of thought. Some traders think that you're going to make a real killing. You're going to make all of your money when markets are volatile. And there are traders, there are short-term traders even, who will go years without really making any money. And then when markets become very volatile, or the particular markets they trade, they make a lot of money in a very short period of time. That's one way to do it, but it's kind of an uncomfortable way to do it. The other way to do it, I'm speaking broadly, is to reduce your position size as the market gets more volatile. So, okay, let's think about it like this. And I know most of you are not short-term traders, but let's say you're a short-term trader and it's kind of silly to set profit targets, but let's just say your average day is $1,000. You make $1,000 a day on average. And then the market becomes 4 times as volatile. Now, if you don't do anything else, you're likely to make $4,000 a day, or maybe lose $4,000 a day. It won't scale exactly. It could actually be a lot bigger. And you could make mistakes that make the losses a lot bigger, right? But you understand the concept, I think, that if you have a certain P&L and then the market becomes more volatile, you're just going to be levered to that more volatility in the market, and your P&L is going to swing more. So if you reduce your position size, though, let's say that the market becomes 4 times as volatile, and you reduce your position size to 1/4, so you're still making $1,000. I'm grossly oversimplifying, but you get the idea. The way I do this personally is it sort of happens automatically, because as markets get more volatile, the swings get bigger, my stops get farther away because they're set based on swings, and then I look to risk a consistent dollar amount, so my positions are automatically smaller. It's kind of cool how it works out. I didn't realize years ago when I gravitated toward this style, and I sort of backed into it in a lot of different ways, that I'd actually solved almost all of the issues of risk management, position sizing, and position management with this simple discretionary approach to chart trading. Market gets more volatile, you're still setting your stops based on the chart, you set your stops further away, you risk the same dollar amount, your position is smaller. So that's something to think about. And if you find yourself just really freaked out by the market, just cut your size. It's that simple. Get smaller. Everybody's wanting to get bigger. And again, everybody has this fear of missing out when markets get volatile. And I suspect sometime over the next couple of years, we're going to see some real volatility in stocks. We haven't seen that in a long time. And there will be a day of reckoning, because there are a lot of people who are confusing expertise and genius with a bull market. And when the bull market isn't there, it's going to be a little bit more difficult to trade. And if you have emotional reactions to that, just cut your size. Continue to trade so you learn, but get smaller. There's nothing wrong with that. And if you fight against that, then go back to where I started this section and see which of these emotions is really driving you. And above all, follow your plan. That's it. The discipline of trading is really following your trading plan. And if you don't have a trading plan, that's a problem you need to address. And by the way, my trading course can help you with that. So I think that's a good place to wrap up here. I hope these were useful. These certainly are topics that I've been thinking about a lot, that I've been answering a lot of questions on, so I know people are thinking about these. I hope it helps you. Once again, please do check out my site, marketlifetrading.com. If you're a longer-term trader, investor, I'd direct you to Talon Advisors, and that's advisors with an O, one word, Talon, like a bird, Talon, talonadvisors.com. You can read my macro research, my portfolio research there, and we do offer free trials of both, and absolutely money-back guarantees. In fact, for Market Life, it's a more than 100% money-back guarantee. So if you try it, and if you think the service sucks, I will give you your money back and buy you lunch. You don't see that very often, right? I'm that confident in the I'm that confident in the quality of what we do, and I'm that proud of what we put out, that we're very comfortable making that offer. So go check it out, marketlifetrading.com, talonadvisors.com, and I will see you back for another podcast episode. We intend to publish 2 a week. Some weeks maybe 1, but some very exciting things coming here, and I certainly appreciate your time. Thank you very much.
It's never hard